What's up, guys? It's Cash Flow Cart. I hope everyone's having a good day. I certainly am. I went to the gym this morning and I came back and I saw like 3 or 4 supportive comments on the channel. Guys, I appreciate all that stuff. It's awesome interacting with you guys. Although this is still a small channel and a newer channel, I feel like we're doing something pretty cool. We're building a great community of dividend investors. I welcome, obviously, if you guys disagree with something I say, let me know. I'll try to get back to all the comments, guys. I appreciate it all. But let's not dwell on that. Real fast, I did want to shout out the Ryan Dangler Show. He's another dividend YouTuber. He's been doing this for quite a bit longer than me, but he's been pretty supportive on some of my videos, so that's pretty cool. You guys have probably seen some of his content. He's pretty funny, and he really has his own style of dividend investing, so I appreciate that. Today, we're doing the Dividend Stock Tier List, and I've never done a video like this, so let's see how it goes. I got 8 popular dividend stocks picked out, and I will be ranking them, on a tier list. But that sounds like a tall order to do in one video. It's not going to be a full analysis on every stock. We're going to look at 3 metrics instead. Okay. We're going to look at the dividend yield, the dividend sustainability, and the way we're going to determine that sustainability is using the free cash flow payout ratio. If you've been here before, that's how we determine dividend sustainability here. And then we're going to use free cash flow per share growth. And I like to use this free cash flow per share growth trend to kind of get an idea of, okay, what could the dividend be in the future? I prefer to use that trend rather than looking at okay, what's the compound annual growth rate of the dividend? Just because, a company increasing their dividend is completely discretionary and it's up to them at that company. So, I don't want to put too much emphasis on some sort of trailing metric like that. I'd rather look at, okay, what's happening with the free cash flow. Real quick, what's my goal for this video? Guys, my goal for this video is for fun and entertainment. This is not, financial advice. However, I do want you to take away from this, okay, I've got 3 metrics here. 3 metrics here I like to look at, and as an investor, you're going to kind of, with experience, you're going to understand, okay, what metrics work for me, what works best for me, okay? You have this process, all right? You understand that every stock is going to take, maybe you're going to have to look with a different lens. There's going to be some different political risk, diversification. There's different risk with stocks, but if we can start by just narrowing this game down to, okay, what metrics do I personally like to use? Does that make sense? I've picked out 3, and let's get into the video. Okay, guys, like I said, I've picked out 8 stocks. I tried to think of, popular dividend stocks. You can see the logos down here. You probably recognize quite a few of these. I am going to be doing this live, so I don't have some sort of notes on where I'm going to put what, but we'll see how this goes. First up, we got AT&T. I know this is a popular one in the community, a controversial one, but guys, we're going to look at our 3 metrics, and we're going to try and rank this stock in the tier it deserves. Starting out, we're just going to look at current dividend yield. The current dividend yield of AT&T, I'm filming this video in early January, is 6.47%, so nearly 6.5%. I'm going to give that a check mark. I'm happy with that dividend yield. I typically like to enter stocks when their yield hits between 3.5% or 4%, but I will make exceptions, and I preach it on here. You have to look at different stocks with a different lens sometimes. Does that make sense? Next up, we'll go to the dividend safety tab, and we will look at the free cash flow payout ratio on a forward basis. Right here, free cash flow payout ratio, 20.65%. That is lower than the 5-year average. We're going to give that one a check too. So already right off the bat, I'm liking what we're seeing with AT&T, but let's look at the free cash flow per share growth. Go to financials, cash flow. That is where you will find this information. We're looking 2018 all the way through 2023 free cash flow per share right here near the bottom. 2018, $3.30. 2023, $2.76. We cannot identify a solid uptrend with this. So unfortunately, AT&T did not meet all of our criteria. However, we understand the telecom sector. There is not as much growth prospects as I guess there once was. With all these things in mind, guys, I'm thinking we give AT&T either a B and a C, B or a C. If I could put it in between here, maybe I would. I mean, it was sustainable and it does have a high starting yield. I guess we're going to go with B. Not to say that we won't revise this list. Next up, we got Starbucks, guys. Another very popular one, a trendy one, especially amongst young investors. If you guys have watched my portfolio review, you will know I am long Starbucks. It is what I'd consider a medium position for me. I'm not buying it right now, but I'm long 62 or 63 shares at an $82 cost basis. So let's look at it, starting with the dividend yield, 2.44%. That's pretty low. I mean, there's no way to sugarcoat that. It's not the most attractive one. Like I said, I definitely like to see 3.5% to 4% starting yield if I can. A lot of times I've noticed those are going to be like the bigger yield on cost plays down the road. If that dividend yield gets too low, even with an aggressive growth rate, it's going to take some years to get your yield on cost, really impressive. But right now, this 2.44% is not doing it for me. We'll look at the sustainability. Again, dividend safety, cash flow payout ratio on a forward basis, 44.56. That is almost 9% below the 5-year average. That's a thumbs up. I'm going to give Starbucks a check mark here on dividend sustainability. And let's peek at free cash flow per share growth. I think this one could be interesting. Like I said, I haven't gone over any of this stuff, so it's not fresh in my head. Here we are. Free cash flow per share going back to September 2019, $2.65. And then in 2020, only 10 cents. So, that was interesting. A lot of people were staying home in 2020 due to COVID. That obviously hit Starbucks hard. That brings up an important point, guys. When we're looking at these kind of, recent trends, we have to understand it's not going to be perfect. It's not going to be some linear thing. But, we have to use what we can to try to piece together, the story of a stock, what is happening. Great recovery in 2021, 384. Slight pullback, 320 in October 2023. And the trailing 12 months is also 320. I'm guessing that's just, pulling the same data for these two. They haven't updated with the fourth quarter for 2023 yet, I'm assuming. We see 265 and we see it at 320. It's not a perfect trend, but, I guess we're going to give it I guess we're going to give it kind of a halfway check. I don't mind this. So with that being said, where do we want to put Starbucks in the tier list? This is interesting. Only having these 3 data points, trying to let go of any other biases I may have around these stocks. I think we give it A. I almost want to give it B. However, I like the quality more than AT&T for the long term. But again, that may be my own personal bias. I say we give Starbucks A for now. Again, we might come back and adjust this stuff at the end. Let me know if you guys are disagreeing with some of this stuff as I go. But keep in mind, we're only looking at 3 fundamental metrics today, guys. That's what this video is about. Practicing with different fundamentals, identifying how you can read the story of a stock, and then, determining which stocks are going to be attractive, in your own personal portfolio. That's what this game is. Next up, we got Broadcom. This is a super popular one. I know they've had some crazy dividend increases. Before we even look at it, let's look at dividend growth, because people always talk about the dividend growth of this one. The 5-year compound annual dividend growth rate is 19.25%. The 10 years, 36%. And the 3-year is 13%. So that's not something to overlook. That's not necessarily a guarantee they'll continue with these kind of numbers. You have seen they've slowed down a little bit when comparing the 10 to the 3, but these are impressive numbers. Obviously, we are not doing the CAGR in today's ranking, but I just wanted to point that out. Let's look at the yield. The dividend yield's 2%. Okay, so kind of same thing as Starbucks. Not the greatest starting yield, but it could definitely serve as, a yield on cost type of play in your portfolio, depending on your age, your risk tolerance, what you're looking for. So, we're not going to give this a pass here, just zeroing in on the dividend yield. But again, every stock you got to take your own lens with. I almost wish they'd split, not a ton, maybe like a 4-for-1 or something. But, this is just a pricey, this is a big number for one share of a company. I don't know. I guess some companies like to keep that quality, they want the serious guys investing, but I don't know. I'd like to see this one become more accessible to kind of the beginner investor too. Sustainability, guys, we'll go to dividend safety. We'll go cash flow payout ratio on a forward basis. You'll see 42.5%. That is down from the 5-year average. And that essentially means, okay, they're not eating up more of their free cash flow now compared to what they have in the past 5 years. That's good. All right. We like to see the payout ratio currently kind of in line with that 5-year average, because what happens, guys, if the current cash flow payout ratio is like way higher than the 5-year average, okay, what story does that tell us? That tells us that, recently, in order to support their dividend, they're having to commit a larger chunk of their free cash flow to that dividend. Obviously, that is not good. We'll give it a check here for this one, and we will head over to free cash flow per share growth. This will be interesting to see. Obviously, we've seen Broadcom's explosive year. Look here, on a 1-year basis, Broadcom's up almost 90%, compared to the S&P's 22. 3-year, this one is probably a great yield on cost play for a lot of investors if they could have identified this one. I am not a shareholder, unfortunately, guys. We'll look at cash flow and free cash flow per share, $23 in 2019 compared to $42 in the trailing 12 months. That's definitely a check. In 5 years, they have almost doubled their free cash flow per share. We'll give that a check. Okay. Similar kind of story here with this one. The yield wasn't super attractive to us right now. However, it's a very sustainable dividend with great free cash flow per share growth. I think we are going to rank this one. I think we have to give it an A. Like I said, guys, we're only using these 3 metrics over here, and anything in the S tier, I'm going to look for all 3 metrics to be kind of at an attractive place. So I guess A right now, we've got Starbucks, Broadcom. B, we've got AT&T. Let's move on. Altria, MO. I think you guys kind of get the gist of what we're doing. Hopefully I can pick up the pace a little bit. Starting off, we will look at the dividend yield. 9.44%. We all knew, guys, Altria was going to be a check if we're just zeroing in on that dividend yield. We'll look at the sustainability of the dividend, cash flow payout ratio on a forward basis. It's 82.66, and that is above their 5-year average. So, unfortunately, sustainability, we're probably not going to be able to give Altria the check. I keep stressing it, guys, but do understand that in this game, you do have to kind of understand the story of different stocks. In any sort of tobacco or sin stock, they're typically going to have this higher free cash flow payout ratio. And the reason for that is because, there's not as much research and development in this kind of tobacco sector, okay? So their way of rewarding shareholders is going to be through that dividend, all right? It also with a company like Altria, what type of risk may they face? A higher risk of lawsuits, legislation risk. There's definitely a lot of risk in Altria that you can't identify just by looking kind of at metrics. So for that reason, they don't want to keep too much cash on their balance sheet, and risk somebody suing them, right? So they reward shareholders through the dividend. With all that yapping, still, we look at this number, 82.66. We cannot give it a pass. Free cash flow per share growth, I think there's a lot of Altria bears out there, but I think this metric is going to surprise you. Let's get into it. December 2018, $4.32, and the trailing 12 months, $6.27. Okay. This is a beautiful trend. This is one of the better free cash flow per share trends we've seen. That's going to be a check with, a check with distinction. Whatever. What am I trying to say? We will give Altria A tier. Next up, we got Verizon. VZN. Let's get into it. Oh, is it just VZ? What am I doing? It's just VZ. Obviously, I'm not a shareholder of Verizon. Dividend yield on a forward basis for Verizon, 6.76%. Mia, stop. She's trying to get her bone back, but it's too noisy when I film, so. 6.76% on this one. We'll look at the sustainability. Same thing, guys. We're going through a process. I know this video is a very simple process, but I want you guys to understand, if you're starting out, you're going to have to understand metric by metric what works for you, what can you read well, and what resonates with you, okay? So we've picked 3 out. I like these 3, but, maybe you prefer something else for sustainability. Plus we haven't even touched on valuation, although dividend yield can be kind of a way to determine valuation. Regardless, cash flow payout ratio, 29.84%. Slightly above the 5-year average, but that's okay. Financials, cash flow, free cash flow per share here. There's no trend. Not to mention, December 2021 was a big negative of $6.83. I don't know. I unfortunately haven't done enough due diligence on kind of the AT&T versus Verizon argument, but my gut tells me, and using these three metrics only, we are going to put that one here in C tier. Let's move on. Again, guys, if you've got something to say, if you think I'm not being fair with some of these, feel free to let me know. I can take criticism. Apple. The yield for Apple right now, I mean, this is not going to be an impressive number, but 0.53%. So Apple's dividend right now yielding 53 basis points. That's obviously not going to pass that category. Sustainability, I think we already know kind of the story with some of these bigger guys. We know it's going to be sustainable. Cash flow payout ratio on a forward basis, not even 12%. Again, down from that 5-year average. Okay, so it checks out there. And then financials, I'm expecting to be very pleased with their free cash flow per share growth, but let's double check. $3.19 in 2019, $6.33, in the trailing 12 months. Beautiful uptrend here. 2022 was actually a little better in terms of free cash flow, but the trend is there. I guess we got to put Apple up here with these A tier guys. Remember, guys, these are the ones that had two of these three metrics. They checked in two of these three categories. Next up, we got Coke. You guys know, and you're probably tired of hearing me talk about Coke all the time. But for me, it's just a great example of a company with a wide moat, with great metrics, great trends. It's one that's easy to talk about. I think it's a great stock to make a lot of teaching points. So guess what? I'm going to keep talking about Coke. I am a shareholder. Try not to drink too much Coke, though, but it's pretty good. Dividends. That starting yield at 3.08%. Again, I don't think that's a screaming buy. So we're not going to... It's higher than kind of some of these other guys we had up here besides Altria. But I don't know. I'm on the fence about that one. Again, guys, we're just looking at that starting yield. Sustainability, let's get into it. Dividend safety, cash flow payout, 66.55. It is down from that 5-year average. I think we're going to give this one a check. Doing this now, I'm realizing kind of how hard it is to talk about some of these metrics in isolation without trying to take, okay, what sector is this? What stage of growth is the business in? But, I'm happy I'm challenging myself with this, guys, because before you can really kind of find your discretion, find your style of dividend investing, you are going to have to put in the work. Okay, I need to be able to read these metrics. I need to be able to understand what they mean in isolation. And then, as I become a little more experienced, then I can start to, understand the nuances of things. And I'll try to explain a lot of that stuff on my channel. Today's a little more simple video. This is a sustainable number. Free cash flow per share, financials, cash flow. That's a check. We see that uptrend. No, it's there. $1.43 in 2018, trailing 12 months, $2.35. That's what? About a 60% increase. $1.43 times 1.6. What am I doing? 1.6. Okay, it's a 65% increase, or 64.5. I guess my mental math isn't perfect, but we'll take a 64% increase in free cash flow per share in 5 years. And that is going to take into account total free cash flow as well as shares outstanding. Okay, I love this metric. It kind of kills two birds with one stone, in my opinion. And I probably talk about it in almost every video. What did we say we want to give Coke? It passed sustainability. It passed this trend of free cash flow per share. The yield was just over 3%. I guess I want to give it A tier. Looking at my stock selection for this one, I think I could have put a little more time into picking some crappier stocks, but we have one left, and I think it is the embodiment of a crappy dividend stock, and that is Walgreens Boots Alliance, ticker WBA. And guys, if you keep up with news, you'll see right here, Walgreens earnings beat expectations, but dividends slashed. Its stock is plunging. Okay, guys, I mean, we don't even have to look at these numbers. We can to see if they're updated, but understand, what's the best way to kind of drive this point home? Okay, so cash flow payout ratio on a forward basis is 42%. But again, that's after the dividend cut. Up here we can see the payout ratio. The earnings payout ratio is 290%. I mean, looking through this one, there's a lot of red flags. Profitability I'll go to, and I've talked about Walgreens before. Even before the dividend cut, I've talked about, how I'm a naysayer on Walgreens. It doesn't take a genius, guys. Look at this net income margin. 40 basis points. I know we're getting off topic for the video, but, this is so important that you understand, how kind of these metrics work, because it would not take you more than a minute and a half to understand, a month ago or whatever, a week ago, 2 weeks ago. It would not take you more than a minute and a half to understand that Walgreens is not a good buy for dividend investors, guys. It was a dividend trap. We got to see it play out. Again, we're not going to have 100% perfect picks in this game, but, if we can avoid making big mistakes like this one, that's going to be better in the long term. So, I put it in D, but I wish I could put it lower. I don't know if I can. Can I add a row? I've never really used this tier maker thing before. I'll put it in D, but I don't feel very happy with Verizon right by Walgreens. So here's the final list, guys. With our 8 stocks, we didn't have any in the S tier. I don't really know what I was looking for this tier, but today we did not find any. Maybe if the market drops and we see some of these yields increased, then we'll see some juicy opportunities, some S tier stocks. We got Starbucks, AVGO, Altria, Apple, and Coca-Cola in the A tier, AT&T in the B tier, Verizon in the C tier, and that one that should not be named in the D tier. I think of myself as a pretty peaceful guy. I don't like much drama, but there is a particular finance YouTuber. I used to watch him years back, and he always talks about his big position in Walgreens. That goes to show there's a lot of people on YouTube, guys, that do not really do this. They don't go through numbers. I guess they try to farm views. I'm not trying to hate, and I should probably stop talking, but I'm not even going to mention their channel. Okay. We might cut that out. We'll see. Guys, I'm Cashflow Cart. Thanks for joining me for this video today. If you like this type of content, feel free to subscribe. If you're already subscribed, thank you so much. Today's video was kind of random and fun, and we definitely have more serious content, more news type of content. We got it all. 2024. I'm really looking forward to interacting with you guys in this community, hopefully building the community a little bit. And guys, have a great rest of your day. Take care.